Everybody, I hope you are well as we move into spring break here. Some already on spring break, but for most next week or the week after. So I hope you can enjoy that if you get some time off. Markets have been volatile and for the most part negative over the last couple weeks with all this uncertainty around trade tariffs and all these negotiations going back and forth. Not just us here in Canada with the US, but also Mexico, China, and even into Europe. Lots of talk and lots of uncertainty around where trade tariffs are going to land. That's caused negativity in the market. So I wanted to share a little bit perspective historically on where the volatility is in the markets and hopefully put you at ease a little bit that we will get through this. And of course, it can happen at any moment with negotiations ongoing. But I wanted to share a little bit. I've shown this chart before. The blue bars showing you what the S&P 500 did for the year, the calendar year in total. So you can see the majority years positive, but of course there are a few negative years on there. Those yellow diamonds showing you what the maximum pullback from a high was at any given year. So any sort of correction that you saw, what the largest correction was in those years. You can see the average return, 10.3%, even with those negative years. But the average correction was a negative 14% from the high on any of those years. As you can see, we're at, well, it's showing you 8.6. It's actually about 10%. It's a few days old. But last year we had a correction of 8.5%, which is hard to even remember after the positive returns we saw. You remember in 2020 ended up a positive year, but that was a large correction as well. So not to say this correction is over and that it can't get worse, but keep it in mind that we do get these corrections quite often, and at any given moment, it's a different reason. So although it feels like this time is different, and the reasoning might be the market's going to return the same in the long term over the long run there. So here's another way to look at it. This is just over the last 20 years, but you can see the average return of 9.72% for the S&P 500. But look at that first quarter there. So January, February, March. We talked about this a little bit in the last video of February, the end of February being a weaker period. But really that first quarter, pretty flat. And the average bottom of the market has been March 12th. So we are past March 12th. We haven't quite bottomed. As the 13th was weak as well. So we don't know where that's going to be, but historically over the last 20 years, you can see that the last three quarters are where all the gains and where that 9.72% has come from. So that's a good sign. Of course, a lot depending on where these tariff talks go over the short and long term. Here's another way to look at that famous quote that this time it's different. Again, the reasoning might be different, but the markets return the same in the long run. 2009, of course, the financial crisis, big decline, but we did have smaller corrections 2016 and actually two in 2018. Of course, the COVID pandemic in 2020 down almost 34% from the highs. We had recession fears in 2022. And now here we are in 2025 with this 10% correction. You can see looking 1 year, 3 years, 5 years out, some very large returns bouncing off those bottoms. Again, we don't know where the bottom is, but all of those corrections had different reasons. And all of those outcomes in not even the long term, but in the 1 year, let alone 3 and 5, very positive returns bouncing back off of those. So again, we don't know exactly where the bottom is, but we know what's going to happen in the long term. So what can you do about it? Well-diversified portfolios, rebalancing if possible, the dividends, the interest, all of those, putting those in to things, or as we did last year, you could take some gains off the top of the higher, better performing investments, put those in, make sure your risk level's where it needs to be based on your objectives. But don't go changing those objectives or changing those risk levels just because you have a feeling, because the decision to get out is tough. When do you do that? Of course, nobody has a crystal ball. But from experience, the decision to get back in is even tougher because the best time to get back in is when the markets are weak. and they are weak right now. And as they get weaker, if they get weaker, it's going to feel even worse to invest those funds. So there's a few quotes to just put out there. And these are long-term quotes for long-term investors looking at the very long-term history of the stock market and how it's performed. Again, the reasoning for many corrections or many bull markets is different, but the long-term history is the same. So one good quote right now: the stock market is the only market where things go on sale and all the customers run out of the store. So that's, again, if you have high quality investments and they're down 10, 15, 20, 30%, not to say they won't go a little bit lower, but usually that is the better time to buy. Time in the market beats timing the market. This is a very famous quote. Impossible to time the markets. Again, at any given moment, we could get an announcement that negotiations on the trade tariffs have gone well, and the markets could head right back up. So it's impossible to time. But the bigger risk being you're out of the markets when these positive markets happen, and you miss out on those gains, as opposed to having, with your long-term money, having to sit through some market volatility on the negative side. The last quote there from Warren Buffett: the stock market is designed to transfer money from the active to the patient. Again, another kind of market timing quote, but those that are pulling money in and out on that feeling that things are going to be negative usually underperform those that are patient and just wait through that market volatility. Again, make sure your plan is solid and your objectives are aligned with the risk level in your portfolio. Rebalancing as needed in those portfolios is going to help, and then that diversification, so you're not just in one large cap US sector, for example, or any other given single asset class. You have some diversification both globally and in various sectors and alternatives, all of that sort of stuff, to offset some of that risk and reduce some of that volatility, especially in times like this. So all of those are things you can do. Happy to chat with you at any moment for those. Otherwise, I will be back with you, maybe not in the next week. I am away, but I'll be back with you at least in early April. So take care.